appreciate that you've come all the way to attend this amendments class, and I hope that it really helps you, because we are expecting not less than 20 to 30 marks from this discussion that we are having. Okay, so let's pray that next 3 to 4 hours we spend will be effective and we will make the best use of the time. Okay. So meanwhile, have you seen the handout? Have you seen the handout? So this handout, if you look at the index, in this index I have not put ICDS. You are anyways carrying your supplementary material, so I think we can run through that to understand. So meanwhile, for today, this is what we are planning to study. Okay, so we will run through all the topics slowly, and wherever possible, wherever needed, I have ensured that we insert a question either from the supplementary material or from a standard book, okay, some author's book, so that it is not just learning the theory but also understanding the exam point of view, what kind of questions can come. That is very important for us. So that is the plan for today. Okay, so to start off with, so there's nothing big deal when it comes to the rates. Finance Act 2015 has not amended the basic exemption limit, it is the same. Okay, but one thing you should remember, they have abolished the wealth tax, because of which, on abolishment of wealth tax, what did they do? They have increased the surcharge. Okay, that is one special point that you need to remember. So now, if you have a look at this, the page number 1, this page number 1, you are seeing that the surcharge has been increased. In general, it was earlier 10%, now they have made it 12%. And for the companies, if fine became 7, that you have to check 1 crore, but it is not more than 10 crores, and it is 7%, but if it is more than 10 crores, then 12%. But if it is a foreign company, it is 2 and 5. So this table you need to by heart. More important is the next table, okay, because we know that assessment of companies is very important from exam point of view. So I am sure you may get one question from this area, whether it is dividend distribution tax or it is tax on mutual funds, whatever you are discussing, this table is going to help us. But one thing you need to remember, by heart the rates, effective rates of these table, but look at the note also. The note is very important. We know that at 2 places grossing up is needed. Okay, grossing up. Now what do you mean by grossing up? Yeah, so these rates are without grossing up. And when we want to do grossing up, what do we do in the denominator? In the denominator, yeah, we instead of putting 100, we put 100 minus R. So accordingly, these rates would change. And this grossing up is applicable only in case of 1150 and 115R. Okay, so just take care of that. That is one important thing which I wanted to stress. Okay, now coming to your definitions. So what happened to the definitions? Let us carefully watch. Okay, so coming to your definitions, the first definition which we are expecting one question in the exam is charitable purpose. Those who have already heard, it's a revision for you. So let us spend some time and finish learning what is charitable purpose. Okay, so we have to remember charitable purpose has to be discussed from 2 limbs. One is, it is relief to poor, yeah, it is education, it is yoga, yoga word added now, it is monument, it is environment, and it is what else? What else is there? Medical relief to people. Okay, so these 6 you need to remember. I will repeat again. P stands relief for poor, E is standing for education, Y is yoga, this is monuments. So let's say you want to protect Taj Mahal, you want to protect Charminar, or it is again environment. Environment includes wildlife, it is conservation or afforestation, everything. And last M is again to the poor people. Instead of education, you are extending some kind of medical benefits. So this is 6 set is defined by the taxman in charitable purpose. You have to add, there is no etc. here. You have to remember this as it is. This list is very important. Now coming to the next one which we will say is anything which is general public utility, any object which is general public utility. This is what you need to remember. What do you mean by any object which is general public utility? Yeah, in addition to these 6 things, there are so many people who are into doing different things. Somebody is like helping sports protection, sports promotion, or somebody is into protection of Indian culture, or somebody is into park, they're taking care of parks. Okay, public parks are not well maintained by the government. So there is an NGO which is always taking care of parks or animals, etc. So maybe it can come here. So this general public utility, you have to open up your mind and think, the people who are getting benefited here need not be poor people. Under this general public utility, even you and I can start an organization in the interest of chartered accountants. For helping the CA students, we can start one NGO. So now the CA student need not be poor. You can just target one section of the society and try to extend some services to them. It could be a Footwear Association of India. That fellow is helping all the footwear manufacturers. Or it could be Export Association of India. That export organization is helping all the small exporters. So here we are not stressing who is the person receiving. Here poor concept is not there. Remember that. It is general public utility. So once we bifurcate like this, we will now say what kind of income these people will earn. So for these 6, we are saying they can receive any kind of fees or collection. Okay, so for example, if you are into monuments, Taj Mahal, entry fee into Taj Mahal, you will collect some money. Yeah? Or it could be a business which is incidental. It could be business which is incidental to main objects. Now, for example, the organization which is protecting Taj Mahal, what can they do? They can give some printouts of the mementos. Okay, they can allow cinema shooting here. Whatever cinema shooting collections they get, they will use it for preservation of Taj Mahal. So any business which is incidental to main object, this business need not be connected to the monument. It could be out of monument also. But what is needed is the collection money that you get from the business should be spent on the main objects. This is the criteria. Okay, this is very important. On this, there was an exam question. One organization, charitable organization, which is actually into extending education, okay, for poor people. But to get money, how to do this charity work, they don't have enough funds. So they started selling water, okay, they are selling water to different companies. And whatever money they get from that sale of water, they are using it for giving education benefits to poor people. So see now, actually if you look at the NGO is into education. And sale of water has got nothing to do with it. But it can fit here. Here it says anything which is incidental to main object, the interpretation is different totally. What is the interpretation? The money that you get from the business should be spent on charity. If you satisfy that, you fall here. Alternatively, the business is not incidental to main objects. Okay, then in these 2 cases, we will say the NGO is still a charitable organization. It is still a charitable organization and it is eligible for exemption under section 11 and 12. This is one important thing. But when it comes to business which is not incidental to main object, they are doing something else. Okay, when it is not incidental to main object, then we will say the trust is charitable, no doubt. We are not removing the name called charitable. It is charitable, but only thing that we are doing is the business income is taxable. The business income is taxable, but the other income, other than the business income, other income is donations, voluntary contributions, income derived from the property held under trust. All that other income is eligible for exemption. So here nothing changed, but we cannot understand the amendment until and unless we know the definition in total. So this is what you need to remember. So this is over. Can we move on to the next one? Yeah. Now when it comes to general public utility, here amendment has come. So what is this amendment? Let us see. General public utility. Question from here is for sure. So general public utility is carrying on commercial activity in the nature of trade. Commercial activity indicates it is something connected to trade, it is something connected to services, and they are collecting money. They are earning money. So if you are doing something commercial And this commercial activity, we need to find out what is the nature of this commercial activity. Is it incidental or it is not incidental? So we will say it is not related. It is not related to the main objects. It is not related to the main objects of the organization. Then if this organization is not charitable in nature. It is not charitable in nature. It's not a charitable organization. They may argue. What kind of argument they will do? The argument is invalid. Which argument? The business income is used for doing general public utility activities. They may argue like that. So they are saying that it is not related to the main objects. They are running a restaurant. They are earning income from it. And that money they are using it for constructing of hospitals, schools, etc. So they are saying that restaurant income is used for construction of schools and buildings. So we want exemption. So we will tell them if it is a commercial activity and it is not related to the main object, then in that case the business income is used. Yeah.
PS 13 easily 6 and 7 9.
You just take their keys and shift the way.
Reputed 4 9 3.
Okay, sorry sir, we didn't know. They are new today. They didn't come earlier, so they don't know where to park. We will take care from tomorrow.
4 9 3.
Okay. So let's come back now. So we're not related to the main objects and it is not charitable and the argument is invalid. Which argument? Business income is used for doing general public utility services. This argument is invalid. Next one is a commercial activity which is related to main objects. Related to main objects. That means it is there. They are selling books. Something which is connected to their main objects. It's a sports organization. So they are, sports organization, what can they do? They can, let's take this, they take some bats and sports equipments, get it signed by the cricketers and they sell them. So something which is related to the main object and they're making a lot of money with that income. Then what is the law telling? Here is the amendment. If it is related to the main object, we need to find out what is the size of that business income. If the business income from this activity is less than or equal to 20% of the gross receipts, then the organization is charitable. We can still call it a charitable organization. Alternatively, or the business income is greater than 20% of gross receipts, then we will say the organization is not a charitable. Organization is not a charitable. Okay, so here comes the amendment. Last year you might have studied that the limit was 25 lakhs. Now they have removed 25 lakhs and rather they have put 20% as the criteria. So what are they asking us to find out? They are saying whenever you do business, just see the size of the business income. If it is more than 20%, then it is not charitable. And when we say not charitable, immediately you will get a doubt. What are we going to do? You will say note for that year, for that PY, there is no exemption under 11 and 12. There is no exemption for 11 and 12 for that PY. No, not. What is not needed? Not needed. What is not needed? Cancellation of registration is not needed. This year it has crossed 20. Maybe next year it will be less than 20. So why do you cancel? So no need to cancel the registration under 12AA. Then what do we do for them? We should only tax their income. Okay, at MMR we will be learning the tax rates and all. So this is what you need to remember. Now observe, when it comes to those 6 objects, the taxman was very kind. He never put this criteria and he said we will continue to call you charitable. But when it comes to any other object of general public utility, here anything can come. News related activity can come, sports related can come. Anything which is coming here they are trying to catch the commercial element and they are saying if your business income is more than 20%, then you're not charitable for that year. You will lose the benefits of 11 and 12. You will get taxed. Okay, this is the conclusion. So just look at this item 1. Question number 1. All of you come to your book. Okay, so look at this point. Gross receipts of a trust having its main object as advancement of general public utility. That is, it is not those 6 things, it is something else. Okay, gross receipts is 20 lakhs. It includes a receipt of 2 lakhs from the activity in the nature of trade, which is undertaken in the course of its main object. Page number 2, there's a question here, page number 2. It satisfied all the other conditions as undertaken in the course of actual carrying out of its main object. It satisfies all other conditions as prescribed for exemption. Will the trust be denied tax exemption? Comment. Okay, so what is this? Whatever we discussed now, this story, okay, this story which you have discussed now, actually this is coming by way of reference to proviso to section 2 subsection 15. By referring to proviso to section 2 subsection 15, we are writing all this. Okay, so what should be the answer? 2 lakhs is less than 20% of 20 lakhs. So write it, 2 lakhs is less than 2 lakhs is less than 2 lakhs is less than 20% of 20 lakhs. 20% of 20 lakhs. It is eligible for exemption. It is eligible for exemption. Okay, see the next one. What would be your answer if the recipient from activity in the nature of trade, okay, receipt is 5 lakhs. 5 lakhs is more than 20%. What is the implication? Yeah, it is not charitable for this PY. It is not charitable for this PY. You all didn't get handout? No? Please come and take it from here, on the chair here. It is not charitable for this PY. You need to remember this. Not charitable for this PY. So what happens? Section 11 and 12 exemptions are not applicable. Not applicable. Okay, everybody done? So one line thing you need to remember, this concept of 20% is not there for those 6 things, it is only for general public utility. General public utility, you have to find out 2 things. Is it connected to main objects? Yes. Another check, is it more than 20%? Then lost. They don't get the charitable head, they get taxed. No, it is less than 20, then they don't get taxed. But alternatively, if they are running something which is very weird, like a restaurant or a magazine, commercial magazine, some commercial activity not connected to their objects at all, then in that case, you will say they are not charitable at all. Call them not charitable. See, anything not related to the main objects is not charitable. Here, are we checking 20%? No, here we are checking 20%. So be careful where you check 20%. Now coming to the next one, there is another amendment in the definition of income. Okay, so let us see what happened here. The next amendment that we are discussing, is definition of income. Income definition got amended under 224 and now it includes a grant. So let us see what happened in this amendment. So prior to this amendment, what was the story? Okay, prior to amendment. Prior to amendment, we were following Supreme Court judgments in cases like Sehni Steels and Purni Sugars. Different companies, case laws are there. There, to call a grant as capital or revenue, they used to apply one purpose test. Why is the grant given? The grant is given to set up the unit. Okay, then we used to call it a capital receipt. It was called a capital receipt. If it is given for smooth functioning of business, then we used to call it a revenue receipt. This was one purpose test. Look at the purpose and then call it either capital or revenue. Under this category, many things were coming, like duty drawbacks were coming, sales tax refunds were coming under this revenue receipt concept. Anything connected to your day-to-day operations, water subsidy, electricity subsidy, or sometimes they are giving you subsidy to expand your marketing network also. Okay, marketing network, everything used to come here. Then what happened? The other case laws started applying is stressing on Make in India concept. Okay, under this Make in India concept, government is coming forward with huge amount of grants and subsidies. Okay, huge amount of grant and subsidies. So they are keeping an eye on these grants and subsidies. That's the reason we also came up with ICDS 7 to handle these grants and subsidies. Okay, at one place they are giving us this grant, at another place they are planning to tax us. So see, under Make in India, they are encouraging the entrepreneurs to go to backward regions and start the units. And they have come up with ICDS, and ICDS is planning to tax us, and they are not even waiting. As per your accounting standards, we are supposed to wait till you fulfill the conditions. Here, even without waiting, the minute you receive the money, they are planning to tax you. So now when ICDS has come to tax the grant, then its corresponding definition is missing in income. So they thought, in order to help this ICDS fulfillment, let us amend the definition of income. So what is the amendment? Amendment is very dangerous. Amendment is telling that grant is only of two types. Grant is only of two types. Anything which is connected to depreciable asset. Okay, anything which is connected to depreciable asset. What they are doing, actual cost, which is referred in under section 43 subsection 1, they are saying for the sake of depreciation purpose from the actual cost, if the grant is for purchase of that asset, please reduce the size of the grant. This is one thing that they are saying. So whenever you get a grant for buying a depreciable asset, please adjust it from the actual cost of the asset, and then on the balance you claim depreciation. And the second half of the story, they say anything which doesn't fall here will fall here. Other grants. Okay, other grants. And all the other grants got added within the definition of income under section 2 subsection 24. Other grants got added within the definition of income under 2 subsection 24. And what are they planning to do? Okay, so this any other grant could be a compensation for expenses. It could be a compensation for losses. You have incurred huge losses and they want to help you write off your losses. It could be to help you with your financial crisis. The organization is going sick, it has huge financial crisis. Or it could be for generation of employment. You are a factory and they want you to generate lot of employment. So they are helping you with some subsidy. Or it could be for industrial promotion, expansion, modernization, or improving the marketing capabilities. Okay, so basically these activities have a long-term benefit. Actually speaking, helping you with your losses, helping you with your financial crisis, helping you set up marketing networks have a long-term benefit. The nature of that grant looks like capital, but see the definition. 224 has said anything which is not falling with respect to depreciable asset will fall here and it will go under the definition of income. So, the reaction of the people was, this is not fair. At one place you are helping us by giving us the grant, at another place you want to tax it. And see their approach when it comes to CSR expenditure. What did they say? You do CSR, we will not give you deduction. Because if we give a deduction, indirectly it's a tax benefit. Here they are saying we will give you a grant and we will also tax your grant. Okay, so this is the amendment, and now you have to just carefully go and read. Tomorrow when we are doing ICDS, today there is no plan for ICDS. Tomorrow when we do ICDS, we will learn how the taxability of grant is happening. But as of now, I was stressing on certain examples. Normally, small examples we understand. Anything which is water subsidy, sales tax subsidy, electricity subsidy, duty drawback, cash incentives, all this is revenue receipt. We can understand. But the impact of this is on the other side also. What is that other side? Financial crisis, losses, loans given, loans waived off. Loans which are waived off are also going to come here. So those which are capital in nature are also coming here. They are creating a fiction and calling it income, and they are planning to tax us. This is the implication of this amendment. Okay, so now what is one line now? Any grant which is not connected to depreciable asset is income under the section 2 subsection 24. If it is connected to a depreciable asset, reduce it from the cost and claim depreciation. Okay. Coming to the next one. Residential status. Okay, so you are very much familiar residential status. There are two amendments, section 6 subsection 1 and section 6 subsection 3. This is with respect to an individual who an Indian citizen and he is a member of the crew of ship. Okay, and this is for a company. This is for a company. So a person who is an Indian citizen and he is a member of the crew of the ship. What are we supposed to do? We have to find out the number of days of stay in India. Stay in India. So for this, they are saying for this year, 366 days minus CDC. Okay, this is the amendment. In order to find out how many days this person is in India, who's this person? He is a member of the crew of the ship. So what does he do basically? He is entering into an agreement with the management of the ship. He is joining his services and this ship is a foreign bound ship. It is going outside India. Okay, so when he is entering into agreement, he is going off. So when he is going off, now what is the possibility? First day, let's say this fellow will go and report to his office. Okay, reporting to his office is 1 day stay in the office. Second day, he may be in the ship but Indian water. And third day, the ship may start from the Indian water and it may go into high seas. Earlier, we used to ask him, how many days you are in Indian land, how many days you are in Indian water, all that put together is called stay in India. Now, we are not asking him like that. We are just asking him to give us a certificate. What certificate it is? Continuous Discharge Certificate, CDC, Continuous Discharge Certificate. So, who is going to issue the CDC under this Maritime Act? Okay, shipping laws are there. Under that act, some authority is going to issue this certificate. So, as per this certificate, let's say this fellow, this certificate will have a start date. What is that start date? The date on which he signed the agreement. Indirectly, it means reporting. When is he reporting? Reporting to his job. And it has an end date. End date means now last 6 months, 7 months he was on the water. You know, people get vexed. They have to take a break. So when he is taking a break, he will sign off. He will sign off his work and come back. So from the date of reporting up to the date of signing off, that period is called CDC period. Period reflected in Continuous Discharge Certificate. When did you report? When did you sign off? To that extent, we are treating this period as stay outside India. So this period is treated as stay outside India. And once we call it stay outside India, we are supposed to remove it off from total number of days. When you remove stay outside India, obviously what is the answer? What is the answer? Stay in India. Stay in India. So now you have to only search for CDC information. So see, there's a question on this. Reporting date up to the date of signing off. Question. In the previous year, Mr. Krishnan, Indian citizen, is vessel manager in Blue Ocean Transit Limited, which operates freight voyage from Cochin Port in India to Colombo Port. Okay, it has to be a foreign bound ship. In India, if it is roaming, then nothing. In Indian coastal waters, then it's always in India. It should go outside on regular basis. It does not involve transit of passengers. No problem. It could be either transit of goods or it could be transit of passengers. Okay. Now see, the date entered into Continuous Discharge Certificate is 3rd August and the date entered into Continuous Discharge Certificate signing off is 31st December. On 1st Jan, he reached his native place of Cochin and resigned his job. That is only to confuse us. Okay. From the total number of days, you need to remove CDC period. This CDC period is the period which is deemed to be outside India. The balance is in India. So, how much is CDC period? From 3rd August. So, you will take from 3rd August to 31st December. And this year being a leap year, just be careful. Okay, even when we are doing our bank audits, we should be careful because of this leap year. Okay, you also when you are solving your problems, just be careful. Don't take risk. So from 3rd August to 31st December, whatever is the period, we will remove it from 366 days. The answer that you will get is number of days of stay in India. Number of days of stay in India. Done? Okay. Now coming to the next one. Now we are discussing company. So we said for an Indian company, the one which is incorporated under Companies Act, irrespective of from where it is managed, it is always a resident. But if it is a foreign company, now we management is in India, it is resident. If the place of effective management is outside India, it is non-resident. Okay. Place of effective management is outside India, it is non-resident. Okay. Now, what is the plan here? What is the plan? Foreign company, place of management in India. What company it is this? This one is a Swadeshi company, and we are planning to put what? Videshi tax on it. Why? Why we are planning to do it? We know what happened to all the high net worth people in India. What do? They earn a lot of black money. So instead of keeping it in India, what will they do? They float companies outside India. Okay, they identify countries like Singapore, Mauritius, tax havens, and they float companies outside India. And they divert the entire wealth there. They create foreign subsidiaries. So we always heard globalization from one angle. What is that? The world is coming to India. Now you should say the second angle. India is going outside. So when you're going outside and you create foreign companies outside, but the people are in India, the effective people managing the show are in India. So if people are in India, we know indirectly it is nothing but our own funds got diverted there. So we are planning to call this foreign company a resident. And what is the implication by calling it a resident? No doubt its foreign income will also get taxed, Indian income will also get taxed. See, one exclusive foreign company, no link at all in India. We're not going to tax it. But look at this foreign company established in Singapore, by calling it a resident, all its income which is earned in Singapore, that also we are planning to tax just because the people managing it from India. So that is the intention behind this. And earlier the words were not place of effective management, it was wholly managed from India, management or control from India. Now instead of using the word management and control from India, they are using the word poem. Now you will get a doubt in this, can we say wholly, partly? No, they are saying when it comes to place of effective management, it can be only in one country. Concept of partly is not there. Effective management can't be from two places, it has to be from one place. How do we bring it to one place? This year, somewhere in the last quarter, they came up with some draft rules, poem rules, but they could not implement. They have deferred, and the budget came and the budget said, we are not ready for the rules, we will defer it to 2017 April. So as of now, we are still continuing with the previous story, wholly managed control from India, wholly management and control from India. This is just for the sake of your knowledge. This has been deferred to April 2017. So we need not stress now, maybe next time. Okay, no, next time we will not come. I always pray that I should not see the students in my next class. That means you should and you will pass. Let's pray for that. Okay, chalo. Let's come to now the next topic, which is deemed to accrue or arise in India. Section 9. Okay, so there are 3 amendments here. Carefully we will do it. Okay, you can sit here if you want, first bench, and if it is not visible, you can push the benches. But be comfortable, that is needed. You are not here for half an hour. So comfort is very important. Okay, so section 9 has got actually 3 amendments. Carefully we will do that. Okay, one we had already discussed, it will be a revision, but 2 of them are new to you. Okay, so what are we discussing now? Section 9. Section 9 has got 3 amendments. Amendment number 1 is the second episode of our Vodafone case. Vodafone case, second episode. But it is making sense. Whatever we will discuss will have lot of implication, and I am expecting you may get a question from here. Amendment number 1 is important. Amendment number 2 is interest paid by a branch to its head office, permanent establishment to its head office. Okay, it is due to accrue or arise in India. And amendment number 3 is with respect to an investment fund management activity. Management activity not business connection. That is the 3 amendments. So maybe this is got some implications. They may design a question on this and give you the other 2 if you remember. Great. Okay. So now section 9, if you want to understand, it is simple here. What are we going to do? All these points you have to read together. The first 5 points. Just have a glance. Look at first point, 5 points on page number 3. Page number 3. Okay, so just look at it once. Okay, done everyone? To understand this, it will take 10 minutes. Now we have a better grip over it. Those who finished, just revise. Yeah. Chalo, let us understand. This was your episode 1 of your Finance Act 2012, Vodafone. Simple. A non-resident Hutch, Hong Kong based company and another non-resident Vodafone in Netherlands. Between 2 non-residents there is a transaction which is transfer of shares of CGP. CGP is another foreign company. Okay, one non-resident sold to another non-resident and the asset sold was a foreign company shares. So actually if you remember the traditional definition of deemed to accrue or arise in India. Okay, deemed to accrue or arise in India, it says something should be in India. Here the seller is outside, buyer is outside and the shares which are sold are also of a foreign company. So actually it looks like foreign income. But now we are going further in finding out. Hutch Hong Kong is a holding company of the CGP Mauritius. This CGP Mauritius no doubt is a foreign company. But when you go to the CGP foreign company balance sheet and see, they have an investment in India which is Hutch India. Okay, so now if they are able to sell the shares of the CGP company at such a huge price, what contributed to the value of the shares? Yeah, what contributed? The Indian Hutch, the business in India contributed to the value of the shares. So actually it is the shares of a foreign company, but its value was derived from an Indian business. So therefore we wanted to tax the situation, and episode 1 2012 we came up with 3 amendments. We amended which definition? Section 2 subsection 14, definition of a capital asset. There we said if you have foreign company shares but that shares has got some rights in an Indian company, even that right becomes a capital asset. And then we said 247, this kind of indirect transfer is a transfer for capital gain purpose. 247 and section 9 said that even though it is a foreign company, because it is deriving its value from Indian business, that income is deemed to accrue or arise in India. Like that 3 amendments came. But these amendments were not full. So they amended further now, 2015. And they came up with some more amendments. Like for example, amendment number 1. See now, in order to tax this foreign company shares, you have studied now that the 5 conditions have to be satisfied. Not one of them, all 5 of them should be satisfied. But to understand those conditions, one by one we will take the example. Now we said this CGP which is transferred to Vodafone, that capital gain is Indian income and we want to tax it in the hands of Hutch Hong Kong. Now we will change the balance sheet of this CGP Mauritius based company and say that Hutch Hong Kong is got 95% stake in it, and one fellow A has got 3% stake in it and another fellow B has got 2% stake in it. When Hutch is selling off the stake, we said it is Indian income. Small people like A and B are selling off their stake, 3%, 2%. They are outsiders, the transfer is outside, the shares of foreign company, everything is outside. Can we go and trouble them, that petty shareholders? Okay, so what should be amendment number 1? Who is the transferor? Who is the transferor? Okay, a person who is having a voting power more than 5%. So they came up with one amendment saying that simply we will not trouble you, we will ask you one question: how big are you? So to call it Indian income for you, you should at least be having 5% voting power. Then we can trouble you. So these fellows, small fellows, petty fellows, A and B, we're not going to trouble you. This is one conclusion. Okay, you can mark this. See, just come and mark this point number 4, fifth one. Fifth point, 1, 2, 3, 4, 5. The transferor company owns individually along with its associated enterprise more than 5% shares. Then we can trouble you. Okay. Amendment number 2. Amendment number 2. See what happened? We said to CGP company, foreign company, that you are deriving the value of the shares are because of the Indian business. Now, how do we satisfy that this Indian business is substantially contributing to the value of the shares? Imagine this CGP, which is in Mauritius, is having investment like this. Indian business, they have 1,000 crores, and Dubai business, they have 9,000 crores, and the size of the balance sheet is 10,000. Now, will you say because of Hutch in India, it has contributed to the share value of that foreign company? Not possible. Because what is this Hutch in India, size of Hutch in India? We are creating a fiction. These are all fictions. What is the size of Hutch in India? Only 1,000. Then when can we say that the foreign company shares were deriving its value from Indian business? How do we know it is deriving its value from Indian business? So they came up with 2 conditions. What are those 2 conditions? This number which I wrote here, what should be the size of this number? Condition number 1, condition number 2. This number should be more than 10 crores. Monetary limit they have come up. This number, Indian business, should be more than 10 crores. And along with 10 crores, they're putting another condition. The size of this should be more than 50% of your total assets. So now if I change this 1,000 and I will now put new numbers. I will make this 7,000 and I will make this 3,000. Now you see 7,000 crores is more than 10 crores and 7,000 is more than 50% of 10,000. Then we can say because of this Indian Hutch, the shares have derived its value, therefore we can call it Indian income. Okay, this is another important thing. Okay, next important thing. Next important thing is from the point of view of proportionate taxation. Okay, proportionate taxation. What does that mean? In the same example, assume Hutch Hong Kong is charging 60,000 crores for the same, this transfer of shares. And they had invested 10,000 crores in CGP. The share capital cost of acquisition for them is 10,000 crores. They subscribe to the equity share capital of CGP at the rate of 10,000. Then capital gain is 50,000 crores. No doubt about it. But how much out of 50,000 crores is Indian income? How much is Indian income? We want to tax, they have sold the entire share, so how much is Indian income? Based on the assets, exactly. So you will say 50,000 crores of capital gain is for a total of 10,000 worth assets. And then how much should be for 7,000? How much should be for 7,000? So we should now learn proportionate concept. 50,000 into 7 by 10. So much is taxable. All these amendments were missing in 2012. So it took 3 years for them to think what is missing. Let me go back and add. So in 2015 they came up with these amendments. Okay, unable to see, pull a chair, go sit there. Be comfortable. One chair here, go sit wherever you want. Okay, done? So now, one thing which is pending for you is to learn this paragraph. All these numbers as on which date we are supposed to check. There is something called specified date. So you have to check that specified date. But just be convinced with the points that you have written. Income of a foreign company in respect of transfer of shares outside India is taxable if the following conditions are satisfied. Fair market value of Indian assets should be more than 10 crores. It should be more than 50% of global assets. And the transfer is not on account of amalgamation or demerger. Now where did this point come from? We have learned in capital gains chapter section 47. Whenever a company transfers something to another company in a scheme of amalgamation, we are not going to tax it. So here in this example, Hutch and Vodafone, it was not an amalgamation. Create a fiction. Had it been an amalgamation and in a scheme of amalgamation of CGP shares are transferred, then we are not going to tax tax them. When it comes to amalgamation, we are neutral, tax neutral. Now we will not tax. Tomorrow if the transferee is going to sell, that time we will tax. So I told you 47 and 49 will balance each other. Right? So as of now, temporary happiness. You amalgamated will give you happiness. No, it's tax for you. Whenever the transferee sells, that time you're going to tax you. This is the plan. Okay, this was your first amendment, section 9. So what is pending for you is this paragraph. Okay, do it at home. Done everyone? How many points you learned? 5. Yeah, 5 points. Now see the next amendment in section 9. Simple small amendment here. Let us see what it is. Okay, in this amendment we are referring to section 9 subsection 1 clause 5. What are we saying? There is a non-resident which is into banking business. They are not selling goods but they are into giving advances. A non-resident outside India, if it is earning income, when can we call it as Indian income? If it has business connection in India. This was one rule that we learned. Okay, we never said don't look at sales. Okay, your customer may be Indian. Just because the customer is Indian, we're not going to call it Indian income. Rather, we will find out to reach the customer, do you have an activity in India? Do you have a business connection in India? You have a branch here, you have an agent here, you have a subsidiary here who are helping you reach the Indian customers, then we can call it business connection and then we can call it Indian income. This was the rule. Okay, so anything which is through a business connection in India, business connection is permanent establishment in India, that is a branch in India, then income from such branch is Indian income. This is one line. Now the next line is, let us take the example of one organization, let's say Bank of America. Okay, now what happened to this Bank of America? It has a head office in US. And there is another Bank of America which is called a branch in Singapore. We know those who are into banking business, and there is a branch in India, and this is Bank of America, permanent establishment in India, and this one is giving loans to Indian customers, individuals and corporates, Indian customers. So now what we are saying, but this branch in India, permanent establishment in India, in order to give advances, they themselves need money. You and I as public, we may not deposit so much money. So where do they get money to give as advance? The money comes from here. They take it as a loan. It is allowed. Okay, when you take it from your own organizations, they have a lot of money outside India, they are giving it to you, and that money you give it to here in India. So when they are giving loan to you, what will you give to them? Interest. You will pay interest to them. Okay, this is the background. In this background, now we are planning to compute the income of the permanent establishment. We have to compute the income of permanent establishment. So let us say this permanent establishment is treated as an independent enterprise. It is treated as an independent enterprise. And this enterprise, we are planning to do the computation. So for computing their business income, the good news is interest paid is allowed as expenditure. Allowed as expenditure. Your DDAA is also permitting you on this. So what is the, why I am using the word good news? Actually, when is expenditure allowed? When is expenditure is allowed? When it is paid to a third party, outside. You and your branch, your head office are one and the same, self. But still, they are creating a fiction as if this permanent establishment is an independent separate entity. If it is an independent separate entity, then whatever interest they have paid, it is allowed as expenditure for them. Here, there is no issue at all. Amendment is also not here. What is one line conclusion from this example? A non-resident has set up a branch in India. This branch is earning Indian income. We want to calculate its income. For calculation of its Indian income, whenever they pay some interest to its own head office, it is allowed as expenditure. Now the second half of the story. What is the second half of the story? No doubt this is an expenditure. Then what about in the hands of these people? We created a fiction. No. Can we create another fiction? fiction that the one who's receiving, for them it is income. Can we do that?
It is allowed.
For them it is expenditure. Now the second half, this is expenditure. What about these people? It is income for them? Yes. Okay, but unfortunately, prior to this amendment, there was a case laws. And in these case laws, what was happening? Judicial pronouncements. Whenever a branch was paying interest to the head office, the judiciary authorities were saying that it is not an income, not an income. Why it is not an income? What is their argument? It is income from self. How can we earn income from self? Like this they are saying. The judiciaries are saying that it is income from self, it is not an income, therefore not taxable. But lawmakers are saying, then if this is the case, that expenditure should also be not allowed. But we are allowing the expenditure to the permanent establishment. So when we are allowing expenditure, there also it is expenditure to self. But we are still allowing. So when we are allowing expenditure there, then how can we continue with this? So to control this kind of judicial rulings, amendment came. And what is the amendment saying? The amendment says whenever there is a permanent establishment in India and it is making interest payment either to its head office or to a branch outside India, head office or branch outside India, this interest is deemed to accrue or arise in India, and therefore the permanent establishment is also liable what? To deduct, yes, TDS under section 195. So this was the amendment. So we are just continuing the second half. In the first half we were saying for the permanent establishment it is an expenditure. In the second half we are saying when it is an expenditure for them, it is income for them. And because it is income, it is subject to TDS. It is subject to TDS. What are the implications? Assume in the past, pre-amendment and post-amendment, okay, income of the permanent establishment is 100, and assume interest paid is 20. Now also allow 20. Income is 80. Whose income? Income of permanent establishment. 80. Even now. What about income of head office? This interest which was earned by the head office. Prior to amendment, it was nil. No, it is income from self. How can we tax? Nil. Post amendment, it is 20. Post amendment, it is 20. So see now, prior to amendment, government was able to tax only 80. And post amendment, now the government is able to tax 80 as well as 20. Permanent establishment will pay tax on 80 and income of head office will be treated as 20. So this is the conclusion. So what is the conclusion now? One line. Any interest which is paid by a branch. Now see, this fiction is not for what? Residents. Section 9 means whom are we addressing? Non-resident. Okay, to a non-resident outside India, either a head office or a branch. If a branch in India, permanent establishment in India is making interest payment, such interest is an expenditure in the hands of the branch and it is also income in the hands of the head office. Therefore, it is subject to TDS under section 195. Okay. Now coming to the third amendment, 9A. Okay. Section 9A is new, it is unique. Let us understand what is 9A. So to understand 9A, we should actually have knowledge about how the non-residents outside India invest. Okay, foreign institutional investors, they had two difficulties. Difficulty number one, difficulty number two. Difficulty number one was taken care by an amendment in 2014. Difficulty number two was taken care by an amendment in 2015. Okay, what was this difficulty number one? Foreign institutional investors were investing in securities in India. Securities in India. Okay, so first difficulty they had, they wanted to know the character of this security. Because once you establish the character, shall we call it capital asset or shall we call it stock in trade? If you call it capital asset, it will go to capital gains. If you call it stock in trade, it will go to PGBP. Why? What is the big deal? If you call it capital gains, it can enjoy 1038 and it can enjoy 111A benefits. But if you call it PGBP, no benefits. There are no such benefits. Okay. So, but we know, we learned in capital gains chapter how to decide generally whether it's capital asset or stock for you. How do we decide? If you remember 4 parameters we discussed, what was that? How do we decide? You should look at the objects. Okay, if it is a company which is investing, look at the memorandum of association. In the object, are they calling it as investment or are they calling it as business activity? Second thing we said, what did we say? Look at the accounting. In their accounts, in their balance sheet, how are they valuing? Are they valuing by calling it as an investment or stock in trade? Look at their valuation. Look at the frequency of the transactions. Look at the intention. What was the intention? Are you intending to earn profit or are you intending to earn dividend on it? Based on these parameters, generally we call whether it is capital asset or stock in trade. But this parameter story does not apply for foreign institutional investors. Why? The amendment came in 2014 and said, whenever foreign institutional investors buy a security, the good news is such a security is a capital asset. No, they are buying it from business point of view, still call it capital asset. Why? Why we are saying it is always a capital asset? We want them to enjoy 1038 and 111A. Because when we make them happy, what will they do? They will invest in India. So to give them happiness, we created a fiction. What is that fiction? Always the securities which are purchased by foreign institutional investors are capital assets. They are never business income. Okay. Second difficulty that they had. What is the second difficulty that they had? These institutional investors, or let's say high net worth non-residents, if they want to invest in India, how do you think it is possible here? When you and I want to invest in India and we don't have market knowledge, we depend on who? Mutual funds. Mutual funds do the investment for us. Same is the case with non-residents. They also, to come to India, they don't come in their individual capacity. They all come through fund route. Okay, the big people there, let's say 25, 30 people outside India, they create one fund, one organization, they pool their money and that fund is going to invest here. And this fund is monitored by somebody who is a professional, who knows where to invest, how to invest. So even non-residents depend upon the funds. First important thing, remember they depend upon the funds. But now what happened to the funds? These funds, mutual funds, which are helping the non-residents, they had one apprehension. Okay, what do you mean by apprehension? One difficulty they had. What kind of difficulty? They were hesitating. They were hesitating to have activity in India. They were hesitating to have activity in India. They were hesitating to have office in India. Why they are hesitating like this? Because they have learned that word called business connection. Whenever you set up something here in India, then your entire income is Indian income and the people who are earning through you, for them also it is Indian income. Like that they have studied that word business connection. So that was stopping them from coming to India. So they were doing entire investments, they were managing the show from outside India, they were hesitating to come to India. Then government realized, why do you take so much of trouble? Don't worry, you come to India. Okay, we don't mind. You set up an office here, you set up an activity here, you come to India, and the amendment for you is, if you come to India, it is not a business connection. Okay, why we are again making them happy like this? Happiness. We don't want to trouble them. See, unnecessarily if you say it as a business connection, what are the implications? It will override section 9. Section 9 is taken care before amendment I'm saying. Before amendment, as per section 9, entire income of the fund will become Indian income. And if the fund is coming to India, then its residential status will become resident. And once you call it resident, for them Indian income, global income, everything will become taxable. So we can't afford to trouble them. So to avoid that, we came up with an amendment, section 9A. What is that amendment telling? All those funds which are helping the non-residents, even if you come to India, it is not a business connection. You are not a resident. You are still treated as if you are a non-resident, and your income we are not planning to tax. That is the amendment. So I don't know if you can get a practical question on 9A. They may just ask you a theory. One big list of story is there in 9A. Okay, you at least got the idea. What is 9A? What is that idea here? What is it? 9A? Foreign institutional investors, offshore funds are also depending upon mutual funds outside India. But those funds were hesitating to come to India, thinking that it will become business connection in India, and it will become resident in India, and it will be taxed in India. So they were hesitating. So we came up with an amendment. What is that amendment? Whenever eligible fund, we call it eligible investment fund, if it is coming to India, we are not going to say that it is a business connection. So a list of conditions are there, just run through them. Don't waste much time on writing. Just run through it. Okay. Okay, now coming to the next one. These are just, we will read 3 of them. The other 3 we will do when we are discussing the next topic. Exemptions under section 10. Again, see, the best part about amendments and best part about May attempt is, somewhere there is a ray of hope. This may come, that may come. So you should really, study properly. So what is this exemption? So we are now discussing 1011A, we are discussing 1023C, and we are discussing another one, Settlement Guarantee Fund, SGF, 1023E. 1023E. This is what we are planning to study. Okay. Done? So what we know is under section 80C, when a person is contributing money to Sukanya Samriddhi account, maximum 2 girl children, then you will get such contribution is eligible for deduction under 80C. And this Sukanya Samriddhi account, they are following EEE route for it. And what do you mean by EEE route? When you contribute, you will get deduction. When you earn every year, 9.1 they have declared. If you earn every year, it will be exempt. And tomorrow means when the girl child is 20 or she's getting married or she's pursuing her higher education, you withdraw the money, that time also it is exempt. Okay, so EEE route we are following. So now this section 1011A is only clarifying that, okay, interest on Sukanya Samriddhi account is exempt. Interest is exempt under section 1011A. So just remember the basics. When you contribute, you get deduction. When you earn interest, interest is exempt. And tomorrow withdrawal is also exempt. Coming to 1023C. See, 1023C you might have heard from educational institution point of view and hospitals point of view. But the first word of 1023C is one word called notified funds. If you noticed or not, I don't know how many of you have studied this section. Okay, notified funds means what? This section has got so many clauses and sub-clauses in it, which is addressing many issues. And one such issue which is addressed is notified fund. What is this notified fund? If you remember, under section 80G, we learned that if you donate money, okay, Africa Fund, or let's say Prime Minister National Relief Fund, Prime Minister Drought Relief Fund, you're giving money to the fund. You are eligible for 80G deduction, right? Now you should think, what about that fund, the fund which is earning money? Are we going to tax the fund? No, it is for charity purpose. But there should be some section which will tell us, no, that it is exempt. Yeah, this is that section. 1023C is telling all those notified funds which are taking money under 80G route for charity work, they're all exempt. And why we are discussing now, if you have observed, last year ATG got 3 additions in it. Okay, what is that? Clean Ganga Fund. Clean Ganga Fund, Swachh Bharat and National Drug Abuse. They started another organization to handle this drug addict people, drug abuse. So these are the funds which got added in ATG. So when they got added in ATG, what are we planning to say? If you donate money to these funds, you will get ATG deduction. And what is the second story of it? These funds which are receiving money, Clean Ganga Fund, you should see the kind of work they are doing. The websites and all are very beautiful. I don't know to what extent they'll achieve the targets, but as of now they look very aggressive. So whatever they are receiving in the hands of the fund, it is all exempt. Who's telling us? 1023C is telling us. 1023C. Now coming to the next one. Okay, the next one that we are discussing is 1023EE. Clearing corporations, stock exchange related clearing corporations or commodity exchange clearing corporations. The government has passed an order last year saying that they should establish core settlement guarantee fund. Core settlement guarantee fund. Okay, settlement guarantee fund. You should start the settlement guarantee fund. These people should establish. What will this fund do? This fund will guarantee the settlement of trades. Settlement of trades. Okay, what is the intention behind this new order passed by the government? See, we don't want the scams to come again, but we know this securities market, futures, derivatives, whatever it is, at any time market may fall or a scam may happen, the brokers may do a default, they may do something. So we don't want India to get a bad picture. So for the future problems, like for example, we were discussing in our PGBP chapter section 36, if you remember, many NBFCs are coming up with banking business, but any point of time they will declare themselves as bankrupt. When somebody becomes bankrupt, it will affect the deposit holders at large and it gives a bad remark. So to protect them from bankruptcy, what did we say? You all create a special reserve account. You save money in special reserve to face the future bankruptcy, we will give you deduction. Like that we learned. Now a new story has come here. We are saying to the clearing corporations, anytime the brokers may do a fraud or market scam may come, which may affect the investors at large. To protect the investors, no doubt we have an investor protection fund that has got different activities. In addition to that investor protection fund, let us create one settlement guarantee fund. Once we create the settlement guarantee fund, you all people should contribute money, and tomorrow if there is a scam, this fund should be able to protect the investors at large. They should ensure that the trade is settled. Okay, so for that purpose, create one fund, and you all put money into this fund. So obviously, now what will the section say? The income earned by this fund will be exempt under 1023EE. It is on par with investor protection fund to take care of future securities market. They have come up with this idea. So what they are saying, okay, under this security guarantee fund, under 1023EE, this is going to receive contributions. They receive contributions. They will receive income on. The fund will do investments also. Income on investments. Whatever surplus money they have, they will invest. And it will also earn penalty. What do you mean by earn penalty? If one of the broker or the trading member does some kind of default, they will impose penalty. When you impose penalty, is it an income for you? Yes. So this section 1023EE is telling whatever contributions you get from the clearing corporations, from the brokers, from the members, stock exchange is also supposed to give them to help the fund function. Everybody gives you money, that is exempt. You are taking that money and investing somewhere, earning different types of income, that is exempt. And you are imposing penalties on the defaulters, that is also exempt for you. This section is giving exemption for everything. exemption. Okay, but one condition they have put. Okay, what is this condition? If income of SGF is shared by SGF with specified persons, then such income is taxable. So if income of SGF is shared with specified persons, then it becomes taxable. What do you mean by specified persons? It means the clearing corporation, you have surplus money, you're giving it off to them, or recognized stock exchange, or the one who's the contributor to the fund. Just like you have any other charitable organization where people do contributions, this one is also taking contributors from big investors. So if you have a contributor to the fund, or there is a member in the fund, or there is any other broker, with such people, if you're sharing the money, if you share anything with them, you become taxable. You are for the sake of future scams. You should not divert the money for them. So if you are doing diversion of money, this exemption is withdrawn. That is what we are saying. Okay, so a simple section. Now let us move on to the next topic. See, we will come back here. The other three sections I haven't done because I will do it when I am discussing business trust and investment fund. It is not the right time to discuss now, so we will do it later. Assessment of trust. Assessment of trust, not a big deal, not an exemption amendment as such, but just one clarification. Okay, so there is one section called 11 subsection 2, do you remember? Which is allowing you to do accumulation of income. Actually, what are you supposed to do? A charitable organization, 85% of its income should be spent on charity. But let's say you are not spending and next year you're planning to come up with a very big project. Okay, what kind of project? Some school building, hospital building, huge outflow is involved. So when you're coming up with a huge project, why should you waste money now? So what will you do? You will save, you will accumulate. So when you're doing accumulation of income, this accumulation is called deemed application. Okay. In the current PY, it is deemed to be applied. We will not tax you, we will subtract. In the format, we will subtract. But to enjoy this deemed application, you need to satisfy the conditions of section 11 subsection 2. What are those conditions? They are asking you to submit one statement in form 10. One 10 you have to give. To whom? To the assessing officer. This 10 should tell us what is the purpose for which you are saving the money, why you want to save it, and what is the period for which you are saving the money. And this period should never be more than 5 years. It should be less than 5 years. So this form 10, there was a controversy. What is a controversy? When to submit? So the controversy was, even if it was submitted, okay, after ROI, after the due date of filing the return, but before assessment, if you submit, people were getting the benefit of section 11(2). So let me repeat, what did I say? This form they were submitting after the ROI date, after the due date of filing return, but they were submitting before the assessment. So the judiciary boards, what they were saying, that no problem because 139(1) is this form 10 is not mandatory concept, it is only directory concept. Even if you give it to us before assessment, we will still give you 11(2) benefit. So to take care of this situation, one amendment has come. What is that amendment? You can get 11(2) benefits, accumulation benefits, only when, what? The form 10 is submitted. Form 10 is submitted when? Before the due date of filing the return. Before the due date of filing return. Filing ROI. This is one important thing. And the next one is just telling us that how to arrive at that 5 years period. If there is an order of injunction or etc., you need to exclude that, you delete. See, PGP we'll do it at the end because it's connected with ICDS. So I thought I would do it along with the ICDS. So we will now go to capital gains. But let me know if you need a water break or whatever break you need. Do you need?
Yes.
Yes, sir? No? You're comfortable? Sure, everyone? Nobody's sleeping? No fan? Okay. My daughter's not well. She's got fever all night. She was crying. So she refused to stay at home. So she wanted to come. She said, "Nahi jana." So I brought her along. So she seen. Whole thing, kids know, they don't understand it is amendment class for them. How will she understand it? And unfortunately, whenever there is an important class, she is not well. I was feeling very bad for her today. Very high fever. And my sisters come to help us out. Bad, no? Because of the climate, she's not able to. Just the summer started and she's not able to adjust. Now bring her inside. She gets scared looking at you people. Chalo, let's not get disturbed.
Excuse me, one minute. Here it says the amendment that submitting this form is required all are before the due date of filing the return.
Yeah.
Say I file the return first and then file the form.
You don't give it with the return, but ensure that you do it before 31st July or 30 September if you're subject to tax audit. Date is important, whether you're giving return or not. Sometimes you don't give return, you keep it with you. Belated return you give, or don't file a return, but please give form 10 at least. That is what gets stressing. Okay, let's come back now. Capital gains, we will quickly run through it. There are many amendments in capital gains, they are important also. So let us quickly run through the amendments. Section 47, same story here, we just discussed some time back. There is a foreign company A Limited in US and there is another foreign company UK B Limited. And here this foreign company has got investment in another foreign company. Okay, and these two companies are getting amalgamated. And in the scheme of amalgamation, this investment in foreign company is going here. What is the big deal? Why we are discussing again? Foreign company, foreign company, foreign company. But what is the story behind the foreign company? Yeah, this derives what? Its value, yeah, from Indian business. From Indian business. Now because it is deriving value from Indian business, this looks like Indian income, yeah. So therefore when it is going here, we are supposed to put capital gains on it. But section 47 says, whenever amalgamation is there, in the scheme of amalgamation, if any asset is getting transferred, this asset could be land in India also. Take another example, land in India, or it could be directly shares in an Indian company. If it is getting transferred, section 47 says amalgamation we don't want to tax. So no capital gains. But we were just putting some conditions. What is that? Condition number 1. And behind this amalgamation we know people here continue to be here. Amalgamation means what? People here continue to be here. That's what is amalgamation. So when people are the same, there is a question of taxing it. So tomorrow when they sell, that time we will tax. As of now we will not tax. So how do we know people here and here? So we have put one condition. 25% people from here, the shareholders from here should come here to the extent of 25%. And condition number 2, this kind of transfer in your own country you should not be taxable. We are giving you exemption. We are encouraging you, your country should also encourage you. If your own country is not encouraging and taxing you, then why we should encourage? So condition number 2, it should not be taxable. It should not be taxable. If you want exemption, it should not be taxable in your country. In US, in your own country, you should not be taxable. If they are levying tax, then we are also getting tempted to tax you subject to DTAA. That's a different thing. Okay, this was one amendment. What is the big deal? You will get a question on this. Now coming to the next area where we can expect a question. This is important. Okay. So now you have seen last few years mutual fund industry has become very competitive. A lot of competition in mutual fund industry. And to attract the customers, every second month they come up with a new scheme with a new name. End of the day, features are the same. Only name is different, advertisement is different. Okay, to attract us, a new ad will come and they'll attract us. Then now SEBI and government are telling, if you come up with hundreds and thousands of schemes like this, for us it is getting very difficult to monitor you. Okay, so all the mutual funds stop playing with small schemes now, start merging them, consolidate all the small schemes that you have. So now, story started. What is that story? Consolidation started. Now in this consolidation, what is happening? There is one mutual fund, equity oriented fund A, Chota fund. Another equity oriented fund B. Both are becoming equity oriented fund C. Or debt oriented fund A, debt oriented fund B. Both are becoming debt oriented fund C. Okay. Then we will give you exemption. It is just a paperwork which is happening. Earlier also you are the unit holder, now also you are the unit holder. Only thing is, earlier we were saying you were holding units in equity for oriented fund A, but now you are holding units in C because it got consolidated, it got merged, small schemes got merged. But actually sale is not happening. Okay, sale is not. So because sale is not there, we can give you exemption. But this exemption comes with a condition. What is that condition? This and this should be of same type. If you make equity oriented fund A and B and you are merging it with a debt oriented fund, then it is different. No doubt here also Mr. A is there, here also Mr. A is there, but exchange is happening. The capital asset which you are holding, it is getting exchanged. It is not the same. Earlier it was equity, now it is becoming debt. The features are different, the market value is different. So how can we leave you? We will tax you here. So this comes with a condition. I can change the example and write. Now what shall I write? Two debt oriented funds became one equity oriented fund. Type is changing. Whenever the type is changing, there is no exemption for you. So what is the conclusion? If you want exemption, the nature of the scheme should be same. The one which is merging and the main fund should be same. Whenever the type is changing, you will not get any exemption. This is one important thing. So just see for your understanding, one small example is there, will help you run through it. Mr. X acquired the following units. Reliance Stock Bank Equity Fund 3000 units at 10 per unit acquired on 1st February. Reliance FMCG Equity Fund and Blue Chip Equity Fund. And now Reliance Stock Bank Equity Fund and FMCG Equity Fund merges with Reliance Blue Chip Equity Fund. Done? Everything is same type here. And Mr. X is allotted so many units. Fine. On merging, we are not going to tax it. Then when are we going to tax? Tomorrow if you sell it off, the main fund you are selling it off, that time we will tax you. Then what should be the cost of acquisition? Cost of previous asset. What did you buy previously? What should be the period of holding? Or when did you buy previously? Everything. PO's concept, previous owner. So just see. No capital gain. No capital gain. And he is saying that 3000 units, he is allotted 800 in lieu, all that is consolidation. And last line it is saying that he sells everything on 4th Jan for ₹50 each. Chalo, let us read now. No capital gain in the hands of Mr. X as per amendment made by Finance Act 2015. Why? Whenever the schemes are merging, there is no capital gains. In section 47 on merger of schemes of mutual fund. Section 47 is introduced and it says exchange is all exempt. But later on when you're selling, see later on when you're selling 5,800 units, we are doing 3 separate computations. Why like that? Sale price is same, but each lot is different. The first one, blue chip, you had bought on February. The second one, Reliance blue chip, you bought it on, okay, short term is there, long term is there, exactly. So because these are having different period of holding, we need to do separate computation. And because these are equity oriented fund, we are eligible for benefits of 111A and 1038. If it is long term, it will be exempt. If it is short term, they will tax you at 15%. But you are enjoying the benefits. So just run through. The example is quite self-explanatory. You can do it at home. But one line conclusion you need to remember. What is that? In consolidation, you will not get taxed, but if you sell the consolidated thing later on, that will get taxed. Okay. Next one, you need not read. Why? Sometime back we discussed the same thing is coming down. This fifth item, the same example, just look at the board. Sometime back, I was saying one foreign company, another foreign company, and another foreign company got transferred. I'll change the heading. I said demerger. Okay, in a scheme of demerger, things are changing. Same, section 47 will say whether it is amalgamation or demerger, we respect it. It is business restructuring, we encourage, we will give you exemption. But condition is changing. When it was amalgamation, we have written 25%. Now we will write 3/4. The people here should come here to the extent of 3/4. In demerger, the condition is 3/4. Then we can give you exemption under 47. The same thing. Nothing new. Okay, but there is capital gains in the handout. We missed to write something for you here. One item is missing. So that is your GDR related story. And I am sure you may get one question on GDR. Okay, don't panic about reading the entire non-residents, but please at least focus on GDR. Because as an amendment, they will give you a question. Taxation of non-residents under that scenario, they may give. Okay. When we are talking about GDR, we have to discuss from different angles. We have to study your 115 AC, which is a special section to tax GDR. You have to study section 47 also. Two things you need to study. Okay, so now first of all we know GDR is what? A receipt which is issued by an overseas bank to a non-resident and this receipt, the underlying thing, the underlying asset are shares in India. You need to remember this. Underlying asset are shares in India. So overseas bank is issuing a receipt which is called GDR and the underlying shares are asset is shares in India. It could be listed or it could be unlisted. If it is listed, it enjoys 115 AC. When I use the word it enjoys 115 AC, what does it mean? 115 AC is a good section. Why it is a good section? The long-term capital gain is going to get taxed only at 10% and you have some benefits. What are those? Need not file return of income. If you remember, a non-resident, if he is having income by way of GDR under this section, if he is already subject to TDS, he is relaxed from filing of return. So some benefits are there. Those benefits are eligible only for 115 AC listed shares. And we are discussing some exemption under section 47. That 47 is also eligible only for listed shares, but 115 AC is not there for unlisted shares and 47 is also not there for unlisted shares. Then you may first of all get it out. For GDR route, is it possible that the underlying shares can be unlisted? Answer is yes. Government is giving permission even to unlisted companies to go and get GDR for themselves. It is allowed. Okay, so just remember that. GDR route is possible even for unlisted shares. Okay, now first of all, what we will discuss? We will discuss straight away. First important thing is transfer of GDR from section 47 point of view. There is no amendment here. Transfer of GDR, no amendment. Old story only, but it has to be read in total. Okay, what is this transfer of GDR? There is one non-resident and there is another non-resident, and there is transfer of GDR between the two people outside India. Then in the hands of this transferor, we are saying capital gain is exempt. Capital gain is exempt. So because see, people are investing in GDR, they will keep it till maturity, till redemption or conversion. But if they don't want liquidity, they may sell it off to someone as it is. So when they sell it off to someone, we can give them exemption. So automatically now you can say, if GDR is transferred by a non-resident to a resident, no exemption. No exemption under 47. We are only encouraging between non-residents. It is between two non-residents, but unfortunately the transaction is in India. Again, no exemption. Okay, so if you want to enjoy exemption, clearly you should satisfy these conditions. What is that? The transfer should be between two non-residents and it should be outside India. Only then capital gain will be exempt. Okay, this was the old story. Now further what we are discussing. Now instead of transfer, person is thinking about something else. What is that something else? Conversion of GDR into shares. And second thing, shares are sold. Two things we need to discuss. Conversion of GDR into shares. Okay, now people who want liquidity are trying to do trading on Indian stock exchange, but unfortunately GDR is not eligible security to be traded on Indian stock exchange. You can't do trading by GDR. So if you are interested in trading, first of all you should go to central government, put a request to them. What kind of request? Sir, I am interested in trading, please convert my GDRs into shares. So when you request, they will convert it to you, and once they have converted, you can sell it. So now there's a possibility both the events may happen in the same year, or it may happen, this is in PY 15-16, this may happen in 16-17. So what do you think is the taxman trying to do? So first of all he is saying conversion of GDR into share, no 47 exemption. No. How do we calculate capital gain? Calculate by taking fair market value on the date of request. When did you request? Because when you requested, you might have done some analysis. Yes, the market price of the shares are good, the company is healthy, let me convert into shares. You might have done some analysis. So what is the fair market value when you're requesting to the government for conversion? Minus cost of acquisition. How much did you buy the GDR for? That capital gain becomes taxable in the year of conversion. There is no 47 exemption for you, remember. Okay, this is important. This is the amendment area that we are discussing. And subsequently, you're selling the shares. Okay, amendments here. If these shares are sold, capital gain is taxable. Now to tax it, sale consideration, we know we have it, the price. But what about the cost of acquisition? Cost of acquisition, fair market value on the date of request. From here it is coming, cost of acquisition, fair market value on the date of request. Why? Already you got taxed on the basis of fair market value in this year. They should not tax you again. Double taxation should be avoided. To avoid double taxation, fair market value becomes your cost of acquisition. And period of holding will be from the date of conversion. Do you agree? See, you should always think parallelly. Whenever there is section 47 exemption, see the language, whenever there is 47 exemption, we take what cost? Cost of previous owner, cost of previous asset, and whenever we take the cost of previous owner or previous asset, we take which period of holding? Previous asset, period of holding. Now we are not giving exemption, we are taxing, and whenever we tax, we have to forget the old story. That's why see, what happened, are we taking here cost of GDR? No, we are taking fair market value on the date of request as your cost of acquisition. So when fair market value is picked up, the period of holding is also starting from the date of conversion. And at this stage, this GDR is not a listed item, not traded on stock exchange. Anything which is not traded on stock exchange, the period of holding to be checked is 36 months to decide long term or short term. But now once it is converted into the shares, if the shares are listed, 12 months is the criteria. If the shares are unlisted, 36 months is the criteria. So just remember two sections which have come now. We have already discussed, but to write, how do we write? If the shares are subsequently sold, shares are sold, then in that case, one section they added 49(2)(a)(b)(b), which is saying that cost of acquisition of such a shares is equal to fair market value on the date of request. On the date of request. And another one is section 242A, which is talking about period of holding. Holding period of shares is from the date of request for conversion, not from GDR. GDR you might have bought 5 years back, forget it. When did you convert them? From the date of conversion you need to check. Done? There is a question on this, and okay, we have to remember whenever we are reading 115AC, 115AC, if you earn interest on GDR, good news is it is getting taxed at 10%. But if it falls under that sequence of sections 194 LA, LB, LC, which is connected to infrastructure, etc., then this 10 can become 5. So you need to see the nature, what company it is which issued GDR, what are they doing with it. If it falls under infrastructure family, then it is not 10, it becomes 5, but normally it is 10. And we said long-term capital gain on GDR will be taxed at 10%. But if this GDR is converted into shares, then what is the good news? Once it is converted into shares, shares can be listed. That time you will become eligible for 1038 and 111A. So these points you need to remember when you're solving the problem. Okay, so now just see the question once more. Nothing beyond this can come here in the exam. They will just test you on this ground. A non-resident acquired 10,000 GDR of Infosys on 1st Jan 2013. 2,000 per GDR. On 30 June, he made a request for conversion. So whenever you converted, there is no exemption under section 47. And on that day, the share of Infosys was listed at stock exchange at 3,600. The fair market value on the date of conversion is 3,600. The non-resident received share of Infosys on 5th July when it is listed on stock exchange. Okay, when you receive is not important, when did you put the request is important. The share of Infosys was sold later on at 3,000 and STT is paid. So see, it is from 1st Jan 2013 we are computing, it is less than 36 months, right? Then less than 36 months, the answer you see. Less than 36 months. For GDR, we always check 36 months. So because it is less than 36 months, we are calling it short term. And we are arriving at short term capital gain. Now this short term capital gain will be taxed at normal rates. Why normal rates? GDR does not suffer security transaction tax. So you don't get the benefit of 111A. However, next page, when you convert them into shares, and you sell the shares, see the cost of acquisition. How much is the cost of acquisition? Yes. Where did it come from? Fair market value on the date of request is becoming your cost of acquisition. And because these are shares of a listed company, you become eligible for 111A at 15%. Done? Okay, there are some amendments connecting to business trust, but when we do business trust, that time we will discuss, not now. Okay, one more is there about section 47. From business trust point of view, one exemption is there in section 47, which is missing here. So in this list, just give a reference. Come to page number 12. Above this 8.2, right here, refer exemption under section 47. Refer exemption under section 47 with respect to sponsor of business trust, sponsor or special purpose vehicle of business trust. Actually, this amendment had come in 2014. In 47, it came in 2014, but its taxability got changed from 2015. So that's why we have to discuss. We will do it in the business trust chapter. Next all is very easy, and you might have got a message looking at November paper that even basics are important at CA final level. And important basics means what? Your deductions. Deductions most important. You may not study house property, you may take risk, you leave salary, but please study deductions chapter. Especially budget 2015, most of the sections they have changed. Okay, so they are testing us. Deductions chapter got revised. The first one, under section 80C, what got added? Sukanya Samriddhi account got added. So let's say if you're solving a problem for HUF or an individual, sometimes they give you AMT based problems. They want to test your AMT knowledge, alternate minimum tax. That time individual you're solving or HUF you're solving, this will have significance, deductions. Okay, 80C you will get deduction for Sukanya Samriddhi account. Okay, and here we are saying it is to be created in the name of girl child, and there is a restriction of maximum 2. But if twins are born, it is treated as 1. Okay, that again creates a complication. If the first birth is a single child and the second birth are twins, then it is treated as 3, we not give. Okay, like that, too many complications are there, just keep. And this 80C limit we know. 80C limit we will discuss a little later. 80CCC. What is this 80CCC? Nothing new. Contribution to pension plan or pension fund of LIC or insurance companies. Then this contribution is maximum 1,50,000. Last year 2014 they had enhanced 80C limit to 1.5. They forgot to enhance 80CCC limit to 1.5. So this year they said we forgot last year, this year we will make it 1.5. That's what they have done. But here comes the core area, 80CCD. 80CCD. Okay, so just pay attention if you are solving a problem on 80CCD. What is it? Contribution to new pension scheme trust. New pension scheme. Okay, this is nothing but a mutual fund run by the government where they are planning to give you equity based returns, and it is a kind of pension plan for you. Equity based returns you get here. Okay, so now what we will do, we will just divide this 80CCD to a self-employed person. If it is a self-employed person, then what we are telling him? For the self-employed person, we are giving him 2 things. One is a new section which has come by way of budget 2015, 80CCD 1B. 80CCD 1B got inserted by budget 2015. What is this 1B telling? 1B is telling amount of contribution or small b, 50,000, whichever is lower is eligible for deduction. And here 80CCD 1, self-employed person, we are discussing own contribution. Under this own contribution, now what are we writing under 80CCD 1? Small a, leftover contribution. What do you mean by leftover? After adjusting 1B, you have already adjusted some amount here under 1B. After adjusting 1B here, whatever is left over, that will come here. And this is subject to 10% of GTI, whichever is lower. Okay, so you will get 2 benefits, 1B and 1. This one and this one. This one is subject to, overall limit. It is subject to overall limit under section 80CCE. But this one is not subject to any overall limit of 80CCE. Okay, so what does that mean? This 1B is independent of 10% and it is independent of 1.5 lakh ceiling. In this 1B, I am not writing, I said 80CCD 1B is independent of two things, 10%. I am not putting 10% ceiling here, and it is also independent of an overall ceiling of 1.5 lakhs. It is a free 50,000 for you, this one. Whereas this one is subject to 10% as well as it is subject to an overall ceiling of 1.5 lakhs. Okay, so did you finish writing? Next one, just 1 minute, we'll be done. We have to discuss from employee point of view, this one, employee point of view. Okay, chalo, let us see now. From employee point of view, it is easy. We will, if it is an employee, then for him, we will discuss own contribution, employee's own contribution, and we will discuss employer contribution. Okay, for own contribution, we will put two sections for him. One is 80CCD 1B, same what you learned, 80CCD 1. Okay, so here I will write the same thing. What is the amount of contribution? It is subject to a maximum of 50,000, whichever is lower. Then I write same thing here, leftover amount, leftover contribution, and then again I will write here 10% of salary, not GTI, whichever is lower. And this one is subject to 80CCE. Whereas employer contribution, stage 1, we will call it income. Do you agree? Employer saving money for you is income. Somebody saving money is income. But good news is, stage 2, we will give you deduction under 80CCD 2. We will give you a deduction under 80CCD 2. Okay, and how are we going to give you deduction? Same thing. Amount contributed by employer, amount of contribution, small b, 10% of salary, whichever is lower. And here we will write, it is not subject to 80CCE. Okay, now see, subject to, not subject to, how do we understand here? If you go to 80CCE, there you will see 80C plus 80CCC plus 80CCD1. Only these three are there. This should be less than or equal to 1.5 lakhs. In this list, I am not writing 1B. In this list, I am not writing 2. 1B is also not there. 2 is also not there. So these three put together only is subject to 1.5 lakhs. That's the reason I am saying 80CCD1 subject to the limits. 80CCD2 not subject to the limits. 1B not subject to the limits. So this is how you need to remember your NPS. So just look at this question once. The following deduction in respect of contribution by employee to national pension scheme increased from 1 to 1.5 lakhs. Okay, all that we know. The following are the particulars. Read the question once. of investments and payments made by Mr. A employed with ABC Limited during the year. Deposited 1.2 lakhs in PPF. Okay, this one. Next one, paid life insurance premium 15,000 on policy taken on 1st May. 1st May is after 1st April, so sum assured you should put limit 10%. What is that? There are two things now. Any policy taken before 1st April 2012 is 20%. Any policy taken after 1st April 2012 is 10%. However, if it is a disabled person, it is 15%. Okay, deposited 30,000 in 5-year FD. 5-year FD, this is eligible for ATC. Contribution of 1 lakh ATE being 15% of his salary to NPS. Matching contribution was made by the company. Compute the deduction available to Mr. A under Chapter 6A. Will your answer change if it is 1,20,000 being 10% of it? Are you carrying the supplementary material? No? How many of you are carrying? Okay, it's good if you carry. Tomorrow, let's see. Today I don't know to what extent we will be able to wind up. Except for ICDS, we will be able to finish. ICDS, everybody is done. How many of you all are done with ICDS? Raise your hand. We didn't know you are at ICI. Others have to do it again? Okay, then we'll have to come again tomorrow. For ICDS alone, 3 hours we need. Okay, so if those who are done, you can get relieved today. Those who are not done, you will have to stay back tomorrow. Chalo, just write 5 minutes answer. Write down. In this case, deductions. We are not doing everything yet. We are not computing everything of this person. Write down page number 100 if you have. If you do not have, just see the answer. It will help us. Because I don't want you to go back home again, waste time on all this. Finish it here. Okay, so what's the answer? ATC, write on ATC, PPF, inner column, 1,20,000. Next one, life insurance, 10%, inner column, 12,000. So under ATC, we are now writing PPF. See, PPF is also raised to 1.5 lakhs. Some of you are getting a doubt. When I studied IPCC, it was 70,000. Then they had increased it to 1. Now, why are we taking 1.2? It has been now enhanced to 1.5. So we can write here, no problem. LIC subject to 10% of sum assured, 12,000. And 5-year bank deposit is coming to 30,000. Inner column, let it be there, 1,62,000. And then I was telling you that we should first finish off. But to finish APCCD 1, you should actually have knowledge of APCCD 1B. Okay, see the working note now. How much did the person contribute? Amount contributed, how much? 1,80,000. Okay, and I am doing APCCD 1B to know. Okay, how much we can give him maximum? 50,000. Okay, so here it is 50. Second working note. I am doing now ATCCD 1. Okay, for ATCCD 1, we want leftover amount. Out of 1,80,000, how much we have already enjoyed? 50,000. So 180 minus 50 is how much? Leftover 1,30,000. Then 10% of salary. 10% of salary. In this case, they did not give us salary, but they are saying 15% is 1,80,000. So 10% should be how much? Calculators you could bring on the amendment class. 6 lakhs. 6 lakhs is a salary. How much is 10%? 1,80,000 is 15. How much is 10? 1,20,000. Oh. So 10% of salary is coming to 1,20,000. So whichever is lower, 1,20,000. Okay. So we have 2 answers ready with us. Just see, what did I do? I went to 1B first, I adjusted there to the extent of 50,000 I am getting here. Then I am coming to 1. There 1 is telling leftover amount and 10% whichever is lower. 2 figures are ready. Now I will put them here. ATCCD 1, how much can I take? 1,20,000. Okay, in this problem, ATCCC is not there. Put nil. Now I know this amount is coming to 2,80,000. Yeah, how much it is coming to? 1,20,000. Okay, and all put together, this should not exceed. So we will write now 80 CCE. Above amount shall be restricted to 1,50,000. Above amount shall be restricted to 1,50,000. Next line, 80 CCD 1B. It comes separately 50,000. It is not above, so separately 50,000. Next one, 80 CCD2, your employer contribution, separately, amount contributed for employer, do it now, 80 CCD2, how will you do it? Contribution, he is also putting 1,80,000, 10% of salary, 1,20,000, whichever is lower, 1,20,000. So this person is in a position to claim 3 figures in this manner. Just in case if it comes, then we should be in a position to do it. Over. Three figures we gave. Chalo, let's move on. Deductions we'll do and then take a break. Almost done. See the next one. Next amendment in deductions is 80D. 80D. What are the 2 amendments? 2 amendments have come. 80D is addressing which situation? Health insurance. Health insurance. Amendment number 1. Earlier the limits were 15,000. Okay, they have enhanced it to 25,000. The general deduction has been enhanced to 25,000. And the special deduction for if a person is a resident senior citizen, okay, then it is 5,000. There is no amendment in this figure. Earlier it used to be 15 plus 5, now it became 25 plus 5. This 25 is a new figure. It got 10,000 additionally. And this 25 should be read how? How do we read it? Small a, self-spouse, dependent children and parents. So for self-spouse dependent children you get 25,000 and for your parents you get 25,000. Maximum under 80D you get is 50,000. But if any one of them is a senior citizen, resident senior citizen, then it may become 25 plus 30. So it could be 55. Or here also senior, here also senior. Okay, here also senior, here also senior. Then it becomes 60. So 50 or 55 or 60. This is how the limits are working. And one new thing that I got added, very senior citizen, 80 years or more. For this fellow, one good news. What is that good news? Such elderly people, it is not possible to take health insurance. So how do we give 80D benefit for such elderly people? Let's say Mr. A is not a grandfather, so old. How do we know? Grandfather is not allowed, parent. So a parent is so old, how do you give him? So instead of health insurance, we are substituting and putting the word medical expenditure. So for elderly people, you need not take insurance, get them hospitalized, incur medical expenditure, we will give you deduction. How much deduction? Obviously look at the age, 80 or more. Okay, don't say like that, fine. God forbid. Okay, so how much shall we put here? 30,000. Do you agree 30? Where did 30 come from? General deduction 25 and plus 5 because they are seniors. Plus 5, 30. So now some students will interpret this 25, this 25, this 30. No. It is not like that. In this parent story, if possible, take health insurance. We'll give you benefit. If health insurance is not possible and these parents are very senior citizens, instead of health insurance, incur medical expenditure, we can give you benefit. That's what they are saying. It is not additional 30,000. In the story only, one new thing got added, which is expenditure. Done everyone? 80D? Okay. Next one. 80DD. You don't know 80DD? Yes. There is an individual or a HUF resident and these people are having a person who's a dependent who's suffering with a disability. So basically this person who's maintaining this disabled person incurs a lot of expenditure, hospitalization, training, rehabilitation, insurance, this and that. So irrespective of the expenditure, in your family you have somebody suffering with disability and who's the somebody? Spouse, brother, sister sister, parents. Spouse, brother, sister, parents. Okay, no other uncle, auntie, father-in-law, mother-in-law, not there. Okay, irrespective of expenditure, what we were going to say, if this person is having a disability of less than 80% and greater than or equal to 80%. Here it is 75,000, here it is 1,25,000. What were the old numbers? 50,000 and 1 lakh. Amount got revised. 50 became 75 and 1 lakh became 125. Now once we know 80 double D, this was 80 double D. Automatically you will know 80U also. For 80U also these limits have come. So what is 80U? The person is suffering with disability. In his return he wants to claim 80U. So when he is claiming 80U, we are going to give him benefit in this manner. Either 75 or 125 depending upon this thing. Next one, 80DDB. What is 80DDB? Same thing. Resident individual or HUF is got a person who is dependent, same family, spouse, brother, sister, parents, but they are suffering with specified disease. Not disability but disease. AIDS, cancer, neurological problems, etc. Big disease. Then in that case, we said in general it is 40,000. But if the people suffering with the disease are resident senior citizen, then it is 60,000. And for resident senior citizen, 60 or more is the criteria. The age should be 60 or more. But now an amendment has come. If the age is 80 or more, very senior citizen, then the above figure becomes 80,000. These are not and or. In general 40. If the person is 60, it is 60,000. If the person is 80, then it is 80,000. Okay, so and how do you use this limits? Actual hospitalization expenditure or the maximum amount, whichever is lower, minus any reimbursement from insurance company or from employer. 80DD. Okay. Next one, I already mentioned 80G. 3 things got added in 80G. Okay, but you will get it out. In 80G there are 4 categories. 100%, 50%, 100 or 50 subject to qualifying amount. Then these 3 things which got added, Swachh Bharat, Clean Ganga, drug abuse, it belongs to which category? 100%. Category A. That is missing in this chart. Page number 15, wherever it is, just see. Section 80G. All the 3 are eligible for 100%. No qualifying amount, nothing. Put 100% there. Deduction is at the rate of 100%. Okay. Now the last one in deductions. 80JJAA. What is that? 80JJAA. Here we are going to say that we were encouraging manufacturers to set up factories and create new jobs. When they create new jobs, we will give them 30% of wages for 3 years as deduction. Their taxable profit will come down. For 3 years, we will give them 30% deduction because they created new jobs. So now, earlier this manufacturer should be only company, and this new jobs created should have been 100, minimum 100. Then we can give you this deduction. Now the amendment is saying no, company need not be there, any SSC. Any SSC who is a manufacturer, let him come up with a factory, let him come up with new jobs, we will give him deduction. And 100 they removed and made it 50. Okay, new small entrepreneurs they are encouraging. 100 became 15 and company became any. So if individual starts a factory with at least 50 people, then he becomes eligible for deduction under 80JJAA. What is that deduction? That salary, no doubt in his PGBP he will claim as expenditure. In addition to that, from his GTI, he will get 30% of wages as a deduction, and this can be continued for 3 years. Okay, it should be more than 50. Done everyone? There is a question on it, not worth reading. You can refer your supplementary material for that. So we should now come back. We should come back and do international taxation and MAT. MAT, there are a lot of amendments. We have to do it carefully. Business trust is there. Business trust we did it. at ICI. But did we solve a question on it? No. 100 crore. 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 100 crore on business trust, we should solve a potential exam question here. And more than business trust, investment fund, alternative investment fund, a new topic has come. Venture capital funds, everything got merged into alternative investment fund. So they may give you a question from there. So we have to do those topics for you. And